Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, the relevance and policy impact. I'm Govindraj, Ethiraj. Contrary to expectations, the Reserve Bank of India did not cut interest rates in its credit policy on Wednesday. On the other hand, the Reserve Bank lowered its annual growth forecast by 0.5 percentage points to 7.1% for 2016-17, following a cash crunch in the economy, which in turn has hit demand. So the repo rate remains unchanged at 6.25%, while the reverse repo rate stands at 5.75%. Now the question we are asking is, why is the RBI holding back on interest rate cuts when it is quite clear that demand is slowing down in the economy, or is the RBI waiting for more data? More importantly, what are the other tools in the hands of government and the Reserve Bank to spur demand, even to contain the impact of scrapping of old 500 and 1000 rupee notes? To discuss this, I am joined by Soumyajit Niyogi, Associate Director at India Ratings, and Sujan, Hajra, Chief Economist at Anand, Rathi. Thank you both for joining me. So let's get the question out of the way. So in not cutting interest rates, is the Reserve Bank of India basically towing the government's line that there is no real impact of demonetization?
Exactly, that is not the... If you look at the situation, so first thing is that everybody is grappling with the data, whether there's changes in the structure or not, and also the duration of the changes. In this circumstance, also the external factor has actually turned unfavorable. The global interest rates are moving up. Commodity prices have recovered sharper than anticipated. Oil price month on month is 20% up. And is potentially there is a chance that the exogenous shock might arise because of monetary policy.
So you're saying the recession is driven more by external factors than internal factors?
Both.
Whatever
It's
they
actually
may be?
contributed by both. See, in a current situation, the overall the situation is quite volatile and messy. Changing the interest rate corridor at this juncture might not give you adequate result or expected result. So I think it's a very pragmatic decision.
Okay, Sujan, your view?
I think there are three reasons why RBI didn't do it. First and foremost, there is an overhang of liquidity because of the demonetization. So, given that there is more supply of liquidity than demand, the interest rate for banks should come down at any case without help from RBI.
Going to be one of my questions, but anyway, go ahead.
The second thing is that if you look at the Fed is going to raise rate in December, and the consensus is that they are going to tighten faster than what was earlier anticipated. So at this juncture, if RBI cuts rate, there can be a significant volatility in the financial market, including the foreign exchange market.
Okay. So let me put a question. It's like, okay, did you have a third reason?
The third reason is that at 6.25, the repo rate is pretty low.
Okay.
So RBI doesn't have too much of tools in its kit to reduce that rate. So RBI would rather wait and watch whether the growth is really faltering much to do the next.
So now this situation is dynamic, right? So if you go by what we are seeing, reports that we are seeing today, two-wheeler sales, four-wheeler sales, consumer goods, consumer appliances, hospitality, services, hotels, restaurants, all are talking about anywhere between a 25 to 40% contraction month on month. Right? So obviously there is a demand contraction, then there's no doubt about that. Is that sufficient or insufficient data, or should one wait?
The accounts still now is anecdotal. My sense is that if you see in India,
why would you say it's anecdotal? Two-wheeler sales falling 25 to 30% is...
See, this is also the post-Diwali month.
Okay.
So, and there was
month on month, right?
The post-Diwali month, and if you see the...
year on year?
Year on year also it was asymmetric year because
Diwali was in a different month. Okay.
So it's very difficult to draw a firm conclusion from there. But having said that, if you look at that, more than 90% of the retail transaction in India are in cash. So there is no doubt there is an impact. The bigger question is, for how long this impact going to stay? According to my calculation, it will take 4 months to change over from old currency to new currency.
Okay.
So if you think that as soon as Urjit Patel became governor, RBI started printing notes, or government started printing new notes, this should be over by end December.
Okay.
So if it's just a 2-month blip, the impact won't be very much.
Right. Okay. Soumya, what's your sense? Are you also looking at this data anecdotally at this point and waiting before you form an opinion?
Yes, definitely. The reason is that, as Sujan highlighted, that the seasonal impact is also there, and at the same time we have to understand that what is, as we say, whether it's the structural changes, it's all because of the transitory impact. Before coming into the conclusion, it's very, very difficult. So everybody is grappling with the situation. Once the situation comes to the normalization period, say from the January,
right,
I think that would be better to take the fair.
Okay, but the RBI has also lowered its interest rate, its growth rate projections, right, by 0.5 percentage points. So at one hand, it is acknowledging that there is an impact, at least a limited impact. Other economists, as you know, are going much further and talking about even 3% and 4 percentage points, maybe the extreme points of view, right? So where do you folks stand on this?
First thing is that whatever the growth forecast has been trimmed down is basically because of the temporary monetary shock.
Okay.
Can we expect the monetary shock to continue forever? The answer is really no. Neither the government nor the central bank would like to keep the monetary shock for the permanent basis. So because of the temporary monetary shock, so growth is getting impacted. Once everything is normalized, then possibility
Right.
the
So
uptick.
Sujan, let me ask you a sort of socio-economic question here. So a lot of people have obviously held back on purchases or postponed purchases, but in many cases those purchases may never happen, isn't it?
Yeah, there is a loss of consumption.
A lot of this is discretionary, I mean, including travel, eating out, and so on.
Yeah, so but having said that, if you see, if the money is coming back into the system, whatever was the currency in circulation, if most of it comes back to the system, that actually becomes white. So the power of consumption going forward actually goes up.
Okay.
Particularly for big ticket items, because now you have accounted for source of income, so to say.
To some extent, yeah.
Yes.
Yeah.
So in that sense, what do you think the blip in? See, to come back to the issue, the RBI's downgrading of the growth is not only because of the demonetization.
Okay.
Because if you see the first half of the year, the economic growth has been actually lower than expected.
Right.
So it's a combination of demonetization that nobody is talking about the demonetization won't affect. But at the same time, what people are missing out, because the size of the black economy going down, a part of it gets mixed with the white economy.
Of course.
That activity is not real change in activity. But in the accounting sense, so I won't be surprised if the GDP growth for the current year actually goes up rather than down than what we have projected earlier, because the black economy getting merged into the white economy.
Okay, so that's a slightly different point of view. What do you agree, concur with that, Soumya?
See, the first for this year it would be difficult as an institution. Indirectly, we have also trimmed down the growth because
So what's your projection?
so it's from 7.6 we have trimmed down to 7%. So one of the reason is that it's not only for the liquidity shocks, but for the time being is a demand shock, and for the short to medium term it could be an income shock. So that will take time. So the money will shift from one hand to the hands of the fiscal. To obviously the government will spend.
Right.
We expect that the fiscal multiplier to kick in and the gross fiscal and the government spending to come back to the normal level.
Right. So I'm going to come to the steps that the government or the Reserve Bank can take. But before that, let's talk about another part of the economy, which is the agricultural economy. Obviously, the agricultural economy has suffered in some ways much more than the urban economy, and in contrast. What's your sense? I mean, could the losses there be more and in some ways unanticipated?
Of course, the first thing is the timing. So the November is the timing for the sowing for the so many, like one of the major vegetable like potatoes. So temporary shock, but at the same time, yesterday government announced so many steps, the Kisan card, and with the help of the NABARD and other urban and rural cooperatives, I think they will go back to their own territory after some time.
Okay. What about you? Do you impact on rural stroke agricultural economy?
The showing data for Ravi actually shows that there is a more than 4% increase in showing. So though the picture is mixed, for example, it's good for wheat, it's bad for rice and some of the inferior grains. So, but having said that, there is on overall level, Ravi showing has been more than what was expected. Obviously, the transactions in the rural economy are mostly in cash, but what you have to understand, the informal credit system also works there. So even if you don't have immediate cash, you have some access to informal credit. On the top of that, as Soumya has just mentioned, the kind of digital money drive they are taking, it will normalize the situation.
So let me ask you a slightly different question. So when you look at anecdotal data like this and anecdotal evidence as we are seeing now as the impact of demonetization, what in your mind is the transition between anecdotal to real? What is the point at which you, or let's say the Reserve Bank would say, okay, now I have enough data to actually form a conclusion?
My sense is that this will be clear only by mid-January, when you get some of the high frequency data, be it on the core sector, be it on industry, be it on diesel consumption, be it all the high frequency data, also the retail sales data for some select sector.
So that's only a month away. So that's not too far.
Yes, you will get a tentative view, but you have to wait till February to get the Q3 GDP data. To get a more fuller view.
More this thing. Okay, let's talk about steps now. Soumya, why don't you start off? So, what are the tools the government has at its disposal to spur either demand or more money velocity, and which of these could it use or should use?
First thing is this week only government has increased the supplementary budget, so and a part will go to the MGNREGA. That is one of the major booster for the consumption driven thing, and the significantly whatever the money because of the amnesty scheme, whatever obviously government will spend for this year or a larger part for the next year, so that will definitely impact on the fiscal multiplier. The basic consumption level will give some kind of lift, some kind of the booster, but going back to the normal economy after this shock would take some more time to get it normalized.
So what could be the tool you said? So one is government has pulled in more money, and
I think that for the RBI's for this, RBI will continue to be an enabler. By cutting the interest rate might not solve the problem.
Okay.
Now the government will have to play larger role in terms of the fiscal spending and in terms of quality of fiscal spending, rather than just looking at only RBI.
So when you say quality of fiscal spending, can you give me an example?
Spending particularly in the area of infrastructure, in the area of rural
But that was
economy.
going on in any case.
Yes, that is going on, so they can boost up. So the overall economy now requires a consumption boost, and if there is a really sustainable recovery in the Western economy, so definitely that will add further multiplier to the domestic growth story.
Okay, Sujan?
I think there are four things which will happen: two from government, two from RBI. From the government side, clearly the focus of spending will be on rural economy, on in infrastructure, and along with that there will be enablers for digital transaction. So I think that's going to be government focus. So far as RBI is concerned, on the one hand, RBI will keep the liquidity accommodative and thereby press the banks to pass on the 175 bips rate cut, which RBI has done since 15. Second thing, what RBI will also press banks to start lending. So bring down interest rate, so that way to kickstart whether the private side of the economy.
Right. Okay. So when we started, I was asking you what are the factors that are driving the decision of an RBI not to cut interest rates, and as a fact and as a proxy in some ways, you said that it's both domestic and global factors. So if I would ask you both, what are the one or two factors that you think would be the most critical in a Reserve Bank's decision, or for that matter even the government's decision to introduce more liquidity or drive more consumption? What would they be, or what would you be looking at in the next few months?
As Sujan highlighted, already we have reached very close to the bottom of the interest rate cycle. We are certainly not at the 8% trajectory. By looking at the domestic inflation conditions, so you cannot expect that structurally the inflation will not be there. I think the exogenous or external factor will be more critical in the coming year. Already we have seen yesterday ECB's decision, and market to a certain extent
has reacted positively.
Yes, so overall the global economy, particularly Western big countries, are moving from monetary condition, monetary support to the fiscal condition, and that is already replicating, reflecting in the commodity sector. I think the external factor will be.
So you're paying greater emphasis on external factor.
Exactly. Exactly.
So is that a yes? We've run out of time. Just yes or no? Yeah, largely yes. Okay. Well, we've run out of time completely. We need to go in for a break. Coming up on the other side on Policy Watch, the markets have been holding fairly strong in all the turmoil of demonetization. We'll find out how and why. Stay with us. Welcome back to Policy Watch. Even as demonetization is affecting many parts of the economy, notably consumer demand, the markets are holding out fairly strong. Now, the BSE Sensex lost 156 points after the Reserve Bank of India did not cut interest rates as anticipated, but gained almost 457 points on Thursday on global cues, including stimulus measures in Europe. While global flows are looking strong, the domestic story will get weaker before getting stronger, as demand for many products and services ranging from 2- and 4-wheelers to white goods and hospitality has started showing sharp declines in November. Now, the question we are asking is, what will be the near-term impact of this demand contraction be on companies and the economy? Moreover, what are the factors that are going to drive Indian markets in coming weeks, the positives and negatives? To discuss this, I'm joined by Ajay Bagga, Chairman of OPC Asset Solutions, and Anindya Banerjee, Associate Vice President, Currency Derivatives at Kotak Securities. Thank you both for joining me. Ajay, let me begin with you. So, the markets have obviously been holding strong, and is the reason primarily global, or is it to some extent domestic?
It is domestic as far as flows go, because we saw in November 17,000 crores going out from the FI front, while 17,000 plus crores came in from the domestic institutions. So it's more the domestic money which is holding up the markets. However, in the first week of December, we have seen the trend reversing. So around Wednesday, Thursday this week, we saw a positive print on the FI flows. So very early days to really say market is holding up despite the slowdown that is evident due to the demonetization. Overall, people are looking at this being a transient effect. That's what the RBI commentary also mentioned, and we believe that. I think it's a couple of months or maybe at most a quarter more of pain, and then things will ratchet up.
Right. So Anindya, are you also in consonance with that? Transient?
Yes. At this point in time, it's too early to say whether it's transient or not. But interestingly, the past month, the Indian financial markets have quite a contrasting story to tell. For example, the equities are at the right at the bottom of the performance table. Bonds are right at top. And Indian
when you say equities compared to other Asian markets,
compared to almost all markets in the world, in dollar terms, we are right at the bottom. The bonds have done exceedingly well. In dollar terms, we are probably giving a positive return. That's unthinkable in the world. And Indian rupee is the best performing currency out of 23 major currencies in the EM basket. So it's quite contrasting. Basically, that highlights three dominant narratives that is driving the markets. One is the Trump. The second one is the demonetization, which is going to be a growth shock, as well as it's going to disinflate the economy. And third is the whole attack on the informal sector. So those all three together is
combination of three. Okay, right. So Ajay, the thing is, we are seeing anecdotal evidence, perhaps a little more than that. We are seeing two-wheeler sales slow down year on year for November. Four-wheeler sales slow down. Consumer appliances goods slow down. Almost all discretionary purchases slow down. Airlines, restaurants, hotels. So all of this is going to add up to something, and that should presumably impact companies in the Sensex or in the Nifty or the broader market.
See, there are two things, Govinda. I fully agree, and even the service PMI coming in at 46 is a huge shock. So we were lucky that 1.5 of the quarter had gone away, and we are really seeing November. I didn't think got that much impacted because of the waiting lines and stuff, waiting lists in the auto. But you look at cement, you look at services, you look at all around you in the markets. There is a deep impact. Only thing is this translating into a wealth impact also, in the way that our income's going away. If that is there, then it's a very dangerous thing. I don't think that happens, because already if 12 lakh crores have come back, so people have been able to place the money back. And it's a matter of time before that money finds its way back.
But there is some impact at the bottom of the pyramid, right? People are actually not getting wages, or at least not getting wages in hand
and
right
job
now.
Losses. And job losses are there.
But that may not impact the larger number, is what you're saying.
How much does it impact? Because that's a negative saving segment as such, which are perennially in debt. So does that really impact the GDS, the GDP, is what we'll have to see. I would go with the RBI number. They are the most informed people. And if they are talking of a 15 basis point impact and it being transient, that's the best we can do right now. Market has overreacted in kind of hammering down stocks, right from cement to real estate to everything. Things will slow down. Shopping has slowed down, and it's hit right at the festive season. But what is the resilience of the economy, we have to see. So if once the currency comes back, if things start bouncing back, then it would have been transient. Or if, as Anindya was saying, it will take time to really figure out, and it takes 2 quarters, 3 quarters. I don't think so.
Right. So that's the question that, let me put that to you, Anindya, as well. So one argument is obviously that we have enough data, and that's obviously anecdotal, to start taking decisions. The other is we should be waiting for at least a quarter, and perhaps the RBI is thinking along similarly, because they've got the February review to maybe do something if they have to. What's your sense?
See, there are two channels of effect here. One is the whole issue about the supply of cash. 4 trillion or 4 lakh crore has come in. Going by the fact that how much of currency the Indian economy needs, we believe 10 to 11 lakh crore at least is needed without disrupting the economy. That would take another 4 to 6 months, depending on how fast and the lower denomination notes. That's one effect. So that means once that cash comes in, let's say 6 months, economy will come back to some sort of normalcy. The second rung effect is the whole attack on the informal economy. And informal economy is, as far as the service sector goes, that's nearly half the size. The manufacturing, quarter the size. Informal in the financial sector is quarter the size of the GDP. So these are serious numbers, and there the government and the ministers have categorically said we want to formalize the Indian economy. That is a cost. 80% of the employment comes from that sector. So that cost.
So, and if you were to translate that to GDP, if you could do that,
I believe the RBI number is over optimistic. They have played safe, and they have been candid, saying that it's too early for us to judge what will be the impact.
Right, and the only reason we are perhaps discussing this number about whether it's 0.5% or less or more is because then you wonder, is there a response that's necessary and required right now?
Response is required, Govinda. If you look at post the RBI policy, market sold off, but then the next day there was a recovery. So was it due to just the ECB stimulus expectation, or was it due to our domestic factors? The global players have given India a thumbs up, be it the fiscal deficit austerity that the FM brought in, or this monetary austerity that the RBI stood pat on despite all the pressure. I think global players are happy, but the reality on the ground is you've not had a fiscal stimulus for a long time. MSPs have not gone up, so there is no money going into the rural economy. Despite a good monsoon, despite pay commission, everything, because of demonetization, a lot of liquidity is sucked out. Now either you need a pump priming as a fiscal stimulus, or you need some monetary stimulus. RBI doesn't seem ready to play ball on monetary stimulus, so now Mr. Jaitley has to step up, and there are a lot of things you can do. Things like Sweden said that any payment made digitally to a housekeeper or a driver or any services, we will give you a tax exemption. Bring in hundreds of such measures, expand that.
So we've seen the announcement of a few.
That is very
small.
It's very cosmetic. You have to really address the main bulk and give people huge tax exemptions. Second is the capex cycle has ceased up for 3 years. It is not growing. Already it was a huge output gap economy. On top of that, you have brought down volumes again. So you need a lot of pump priming. You need a lot of fiscal stimulus. You don't have the money. So within that, then you have to be more innovative using what resources.
So let me ask you an example. So since we've been seeing a lot of reports on two-wheelers and four-wheelers, if you were to look at, let's say, the whole year or the second half of the year, what could be the potential impact on sales numbers or profit numbers in a broad sense for some of the top companies?
See, most of the big brokerages have cut down the year growth in Sensex EPS down to about 3%, from about 8 to 9%, which was already a revised number. And now they are hurting the 2018 number also, they are bringing it down. So already that impact is there.
Right.
So I would say it will have a 20 to 30% impact on what was the forecasted EPS numbers.
Right. Okay, so let's talk about what are the other counterbalancing forces, Anindya. You've touched upon some of them. Why don't you expand a little more?
Sure. The government can do the fiscal stimulus, which I agree absolutely. But the factor which we have to quite focus on is, do they have the fiscal space? Because they were expecting that a certain amount of this 15.5 lakh crore won't come, and it will be paid to government as a special dividend, which the RBI has said no. So now it all depends on how much of IDS2 will be able to garner. So yes, they can do fiscal stimulus. They will do fiscal stimulus, but government.
So you're saying there's not much room in any case.
It's
even
not
if
much room, and also if they push on the investment lever, that to hit the economy, it takes time. And here the issue is with consumption. So investment cannot really counterbalance consumption in the short term.
Right. Okay. So, Ajay, there was a life before demonetization and then life after that, right? So even before demonetization, we were asking questions about what would growth numbers be like. The economists are saying that the 0.5% reduction that the Reserve Bank has done in GDP numbers may have happened in any case.
Yes.
Right. So is that something that you concur with? And to that extent, is demonetization's impact maybe limited or perceived as limited?
Because they said Q2 was the impact. The 0.5% which they have reduced is due to Q2. Demonetization, just like Anindya said, they've said we will look at it. It might be transient, we can't discuss it right now. So 0.5 was already factored in Q2. What is needed? You can do like give an investment allowance to households. We are a 70% private consumption economy. Say whoever buys a durable or a two-wheeler or a car this year, you can take it tax exempt. Cut down the excise duties like you did in 2008. This is the great financial crisis for India because of demonetization. So the people who have money, self-inflicted for whatever reasons, and we don't know whether it's successful or not. That will a year down the line we'll understand that. But what I'm saying is now you need to take action. So tinkering around saying 0.5% on railway services, blah blah, not that. Come in and see what do people consume, what do they spend on. People who have money, make them spend. So give them tax incentives, say up to 10 lakh rupees, no tax. And I'm cutting down the marginal tax to 20% so long as you spend it on a durable or on a two-wheeler or on a car.
In white.
That has to be in white because of tax. Spot on. Now I don't think black. I was saying December 6th, this time in Bombay, we had no disruption like we normally have because people didn't have the money to bring in those hordes. Now Jayalalitha's death post,
people had to
no
lack
riots.
of cash.
You could not fund the rioters. So it has had a big impact and it's very good. It's productive for the economy to take out those informal sectors, but you have to reintroduce some liquidity, whether fiscal or monetary. If you can't, then give some tax rebates at least, and to the most efficient segments who can spend.
Right. Okay. So let's come back to the markets. So as we've sort of maybe put together, there is a strong international or global overhang on this, positive one. Domestic seems to be stable, so which augurs largely well for the markets in the near term. So Anindya, let me begin with you. If this is the case, then do you see markets holding strong for the next month or two? And could there be something else that we should be watching out for, which we perhaps not touched upon?
It may hold up at least for a month or so because this is the time of the year when the seasonality is quite good and the fund managers will be largely going on the holidays. The trouble starts in January because that's when the whole effect of the demonetization of the economy is playing out. At the same time, the Trump effect in the emerging market is also there. So a stronger dollar, higher interest rates in America. So that may make the journey of the markets quite tricky in the first quarter of the calendar year.
Right. Okay. Ajay?
Markets have a lot going for them. You look at yesterday's decision on the ECB, where they actually talked about a taper from April 2017 and markets reacted favorably. They went down and then came up and ended up. Why? Because there's a huge amount, still $1 trillion will go into the economy, given the 80 billion for the first 3 months. Japan looking good, Europe looking good, US I think grows very big, and there is $2 trillion of offshore US money. He's going to cut down the rate, bring in a one-time 10% tax or something. The Republican Congress is talking 8.7, he's talking 10%. Either of that happens, estimates are 200 to 250 billion comes into the US economy as offshore money. Apple itself is sitting on 200 billion, Microsoft is sitting on 100 billion. You give them an amnesty to bring in the money. So US economy gets a huge leg up and that leads the world up. So I am confident on the markets.
As it has in the past. So you're saying a strong global engine pulling this economy, even if we face short-term sort of hurdles.
Volatility will be there on flows, but I think US economy leads the global economy on a higher trajectory and that will benefit India as well.
And Indian markets as well. We've run out of time. Thank you both for joining me. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.